October 28, 2011, the doors of the New York Stock Exchange swung shut on MF Global, a once celebrated commodities powerhouse, as regulators seized its assets and the world watched a $1.6 billion hole in customer accounts widen into a financial abyss. The name that had once been synonymous with daring bets on oil, natural gas, and agricultural futures now echoed a cautionary tale of hubris, where former New Jersey Governor Jon Corzine gambled with his clients' money and lost everything. MF Global began its ascent in the late 1990s, founded by a trio of former Goldman Sachs traders who saw an opening in the fragmented world of over-the-counter derivatives. With a modest capital base and an aggressive all-in philosophy, the firm quickly carved a niche by offering leverage to hedge funds and commodity producers that traditional banks shunned. By 2005, MF Global had posted $1 billion in revenue, and its stock price rose in tandem with the commodity boom, drawing the attention of Wall Street veterans hungry for higher returns. When Jon Corzine took the helm in 2008, he brought with him a resume that included a stint as CEO of Goldman Sachs, a term as New Jersey governor, and a reputation for bold, if sometimes reckless, decision-making. Corzine saw an opportunity to transform MF Global from a niche broker into a global financial institution. He launched an ambitious expansion plan, acquiring the London-based hedge fund manager Callion Financial and the European commodity arm of Lehman Brothers, swelling the firm's balance sheet to over $30 billion. Under his leadership, MF Global's trading desks were encouraged to push the envelope, betting heavily on European sovereign debt, especially the increasingly fragile Greek bonds. The first warning signs emerged quietly, buried in the dense spreadsheets of the firm's risk management department. In early 2009, internal auditors flagged an over-reliance on short-dated funding, with the firm's liquidity heavily dependent on repurchase agreements that could be called at any moment. Simultaneously, the surge in European debt exposure began to erode the firm's capital buffers. By mid-2010, MF Global's value-at-risk models showed a spike in potential losses, but senior management dismissed the alerts as temporary market turbulence. A second, more ominous red flag appeared in the form of a series of large, off-balance sheet transactions. MF Global had begun to use its customers' segregated accounts, funds that, by regulation, should have been kept separate from the firm's own assets, to finance its own trading positions. These re-hypothecations were hidden in a maze of collateral agreements and were never disclosed to clients. The practice is illegal in the United States, yet the firm's internal compliance officers either turned a blind eye or were overruled by Corzine's push for higher returns. The collapse accelerated in the spring of 2011. As Greece's debt crisis deepened, MF Global's European sovereign bond positions plummeted, wiping out billions in paper gains. The firm's cash reserves dwindled, and the repurchase agreement market, already jittery, began to demand higher haircuts. On July 28, 2011, MF Global attempted a desperate refinancing, seeking a $7 billion capital infusion from a consortium of banks. The request was rebuffed. Lenders cited the firm's opaque accounting and the misuse of client funds as insurmountable risks. On September 27, 2011, the situation reached a breaking point. A routine audit by the Commodity Futures Trading Commission uncovered that MF Global had commingled roughly $1.6 billion of customer money with its own trading accounts. The discovery triggered an immediate halt to all trading activity. Within hours, the firm filed for Chapter 11 bankruptcy, the largest failure of a U.S. derivatives broker in history. Over 5,000 customers found themselves unable to withdraw cash, and the ripple effects threatened the stability of other clearinghouses that had posted collateral with MF Global. The aftermath unfolded in a courtroom, and a congressional hearing that lasted months, Regulators imposed a $10 million civil penalty on Corzine for his role in the illegal use of client funds, and the former governor was barred from serving as an officer or director of any public company. The firm's bankruptcy trustee, James Frederick, uncovered a tangled web of false statements, misleading financial reports, and a culture that prized profit over prudence. In the end, only about $1 billion of the missing customer money was recovered, leaving thousands of small investors and large hedge funds to bear the loss. Beyond the immediate financial damage, MF Global's downfall reshaped the regulatory landscape. The Commodity Futures Trading Commission instituted stricter rules on the segregation of customer assets, mandating real-time monitoring of collateral and imposing harsher penalties for breaches. The Securities and Exchange Commission introduced new disclosure requirements for off-balance sheet financing, aiming to prevent the kind of hidden risk accumulation that had plagued MF Global. In the broader market, the collapse served as a stark reminder that even seasoned financiers like Corzine could be blinded by ambition, and that the lure of high-yield, high-risk trades could override the basic tenets of fiduciary duty. Today, the name MF Global exists only in the annals of financial cautionary tales. The once towering office building in New York's financial district now houses unrelated tenants, its facade a silent witness to the era when a former governor's gamble with customer money led to a spectacular implosion. The story of MF Global endures as a lesson in governance, risk management, and the unforgiving nature of markets that punish excess with swift, irrevocable force. Subscribe to The Collapse for more stories like this.